recording. And I'm going to stop sharing and you can go ahead and kick everything off, Ben.
Thank you very much. Hi, everyone. Thank you for joining us on Cherry's Economic, Real Estate, and Tech Trends webinar series. This webinar series is one which we explore what's going on in the economy right now, how tech trends impact real estate, and how technology is helping us generally understand the economy, real estate economy better. I couldn't be more proud to have Rick Sharga join us today and be our speaker. Rick Sharga is an Executive Vice President of Market Intelligence in ATTOM. I want to say a couple of words about ATTOM because ATTOM is one of Cherry's key partners. And the reason Cherry has picked ATTOM is because we have so much faith in the quality of their information, and Cherry clients get the benefit of being connected and relying on ATTOM data. And that's because we think it's a good data set to start your data journey with. Just a couple of words about Rick. Rick is Executive Vice President at ATTOM. I already said it's a market leading provider of real estate data and property data. Their data includes tax, mortgage, deeds, foreclosure, natural hazard, environmental risk, neighborhood data, and the like. Rick is one of the country's most frequently quoted sources on real estate, mortgage, and foreclosure trends. He appeared on CNBC, CBS News, NBC News, CNN, ABC, Fox News, Bloomberg, NPR, and many other sources. Rick is a founding member of the 5-Star National Mortgage Servicing Association, and he's on the board of directors of the National Association of Default Professionals. With that, I want to make a couple of comments about the format. Rick will be giving a presentation for approximately 30 minutes, and then we will take questions from the audience for about 15 minutes. So please do write your questions as they come along. These recordings will be available later, as well as the presentation, assuming that ATTOM allows it. Yes, I'm getting the nod. So thank you very much, Rick, and please take it away.
Thank you, Ben. Thank you for that introduction and for inviting me to be here. I'm delighted to be here. I'm going to apologize in advance to the attendees because I'm going to be going through about 2 hours worth of content in the next 30 minutes. So as Ben said, we'll be happy to make the presentation available to everybody afterwards. And so just buckle up your seatbelts and we're going to get moving through this pretty quickly. Ben, can you see my screen? I want to make sure I'm actually, okay, good. So we're going to cover a couple high points today. What's happening in the US economy for sure. We'll take a look at the housing market, what's going on in the housing market. We're at a big inflection point in housing, as you're probably already aware. We're going to take a little bit of a look at foreclosure activity with just a quick nod to what we're seeing in the commercial market, because it's a little different than what we usually see. And then we'll talk a little bit about what we see moving forward, and hopefully we'll have some good questions to move into. So what's happening in the U.S. economy? Well, not too much. That's a lie. We've come through a particularly tumultuous, volatile period of time. When the pandemic was first declared, we had the largest single quarterly drop in the gross domestic product in U.S. history, larger than the Great Recession, larger than the Great Depression. And we came out of that roaring as an economy with the largest single quarterly increase in gross domestic product. And when most people talk about the US economy, they're really referring to the GDP, to the gross domestic product. It's the sort of total amount of activity going on economically across the country. Since then, we've had consecutive quarters, 5 consecutive quarters of growth before we hit a rough patch in the first quarter of 2022. And we're in the process now of capturing the data from the second quarter. It's possible, although not likely, that we'll see a second consecutive quarter of negative earnings in the GDP. More likely, we'll see a flat or very weak growth curve. And the reason this is pertinent at all is because the economists' technical definition of a recession is 2 consecutive quarters of negative GDP growth. So a lot of people are looking forward to that second quarter report very anxiously to see if we are technically already in a recession. Doesn't feel like it, by the way, just spoiler alert, but we'll see how it all plays out. We had a remarkable jobs story coming into and out of the pandemic. Never experienced anything like this in US history. We lost virtually 22 million jobs overnight. And 2 things are really remarkable about this job loss and job recovery, which is almost 100% complete right now. The first is the focus of the job loss. So in most recessions, you have job losses across the board: white collar, blue collar, manual labor, professional managerial, service industries, government industries, you name it, people lose jobs. In this particular recession, because it was caused by the government shutdown, the service industries were hit particularly hard. And we're talking about industries like travel and tourism, hospitality, retail, restaurants, entertainment. And those markets just got slaughtered in terms of jobs. One of the reasons we didn't have the fallout in the housing market that some people had anticipated was because of that focus. People who work in those industries tend to be younger, they tend to be less formally educated, they tend to be making less money. And because of those criteria, they tend more likely to be renters than homeowners. And so the people that were losing their jobs, by and large, were not those homeowners who are going to miss mortgage payments. There were some other reasons we didn't have the fallout: government activity, the mortgage industry stepping up to the plate, working within the government programs, literally prevented probably 4 or 5 million unnecessary foreclosures during this period of time. But that was the first thing that was unusual about the jobs story. The second was how quickly we recovered. If you go back to the Great Recession, unemployment peaked at about 10.8%. And it took us a full decade to get all those jobs back. So think about it. It was the last part of the Bush administration, the entire Obama administration, and the first part of the Trump administration. That's how long it took us to get all those jobs back. In this case, we've recovered virtually all the jobs in less than 2 years, which is just, again, unprecedented, unheard of, and partly due to the interesting nature, and I say interesting in quotes, of this particular recession. The labor shortage that you've been reading about is continuing to push wages higher. So we've had steady wage growth. There are roughly 11 million jobs available looking for help right now. There's about 5.5 million people looking for work. So roughly 2 jobs for every job applicant, which is just another one of those metrics that you almost never see. And as partly due to the labor shortage driving up wages, but also due to other factors like supply chain disruption, energy prices, and candidly, the fact that trillions of dollars were injected instantaneously into the economy. We're looking at inflation being at the highest rate we've seen in over 40 years, actually, at this point, almost 50 years. The last inflation report was not encouraging for the Federal Reserve or the administration. They were hoping for a flat inflation rate or perhaps even a modest decline, and instead it jumped from 8.6% to 9.1%. And I would tell you that for people at the lower end of the wage scale, and this is a concern we have watching delinquencies and defaults in the mortgage industry, the FHA borrower pool, for example. Those are borrowers or renters in many cases who are spending a much higher percentage of their take-home pay on things like necessities, food, gasoline. Those numbers typically aren't factored into the inflation rates that you see. So for those families, the actual cost of living increase is even higher than the 9% rate that we're seeing right now. And something we'll be watching until inflation gets under control is whether or not we start to see more delinquencies in the rent markets, whether we start to see more delinquencies in the mortgage markets. It seems likely, unless the Fed gets inflation under control, unless some of these prices start to come down, we will start to see a little bit more weakness in those markets. This is a very, very unusual time in our economy for a number of reasons. This is one. We saw savings rates spike during the early stages of the pandemic due to the government stimulus. So the government was sending us all checks, whether we needed one or not. We were seeing enhanced unemployment benefits. So people were getting a lot more money, and they had nothing to spend it on because everything had been shut down. I mean, there's only so much toilet paper and paper towels you can buy. So we saw savings rates spike to almost all-time highs. And you see that they're starting to come down pretty significantly at the same time when consumer spending is jumping up. And consumer spending is happening both in terms of cash, drawing down those savings, and also in terms of credit card spending. So we're seeing consumer spending continue to skyrocket. And that's happening at a time when consumer confidence has dropped to record lows. So when I said we're looking at unusual circumstances in the economy, this is one of them. Typically, if I were to give you a chart showing you consumer spending and consumer confidence, they'd run in a pretty direct correlation. And in fact, as consumer confidence ebbed and flowed during the early stages of the pandemic, you saw consumer confidence go up, for example, when the vaccines were released. The consumer confidence came back down when the second wave of COVID hit. We saw consumer spending go in tandem with that. That usual correlation is broken right now. No matter what index you look at, the blue bars we're looking at here are the Consumer Sentiment Index published by the University of Michigan. It's the one the press reports on most frequently. Those numbers are as low as they've ever been. And the factors that consumers cite are still the pandemic, inflation, cost of living, the war in Russia, and uncertainty about our political situation in DC as we enter an election year. So it's a question in my mind, at least, and I know some economists who are questioning it as well, whether consumers will think themselves and worry themselves into a recession. One of the things I didn't mention earlier is that about 70% of that gross domestic product relies on consumer spending. So if confidence drops strongly enough that it starts to pull spending down with it, it would not be inconceivable that consumers could worry themselves and stop spending at a high enough level that they could move us into a recession. In my mind, in the mind of a lot of the economists I follow, a recession almost seems inevitable at this point. And this is a chart I borrowed from the chief economist at Fannie Mae. There are similar charts that have been published by Deutsche Bank and some other economic think tanks. But this one shows what Fannie Mae is predicting in terms of a recession in 2023. And this is pretty typical among the economists that I follow in terms of what they think a recession will look like. They don't expect to see us go into negative territory until the midpoint of next year. And they don't see it being a very deep recession, and they don't see it being a very long recession. But they do see it being a very likely scenario. And even some of the economists who've been on the fence, Bank of America for months was saying it was a 30 to 40% chance of recession. Now they're up to 60%. So most of the economists I follow are predicting a recession for sometime next year, but not a deep one and not a terribly long one. One of the reasons I believe it's almost inevitable is because of the actions the Fed has had to take in order to avoid a recession, or in order to get inflation under control. And this chart also from Fannie Mae, showing information from both the Federal Reserve and the Bureau of Labor Statistics, shows what's happened each of the last 11 times since World War II that the Fed has raised Fed funds rates in order to get inflation under control. In 3 of the 11 times they did that, they were able to avoid a recession. What all 3 of those times had in common was they started to raise the Fed funds rate before inflation got too high. In all 8 of the other cases, they acted after inflation had spiked, and in all 8 of those cases, we had a recession after the Fed funds rates were increased. The Fed has announced that it's going to get more aggressive, or as aggressive as needed in terms of its rate increases, in order to get inflation under control. So last week's report about a 9.1% rate of inflation, which was actually an increase, probably suggests we're going to see at least a 75 basis points increase at the next Fed meeting, or maybe even 100 basis points, a full point increase in that Fed funds rate. That makes borrowing more expensive, not just for lenders, but for consumers. but it might just be the kind of strong medicine the economy needs to get back under control. But the more aggressive the Fed gets, the more likely it is we're going to skid into a ditch and have a bit of a recession. The other factor I didn't include a chart on today, but it is a consideration, is something you might have heard of called the yield curve inversions. And that's when short-term interest rates and long-term interest rates kind of reverse position. So as you see long-term rates like the US Treasury rates go up and actually surpass short-term interest rates, or switch places with short-term interest rates, almost every time we've seen a yield curve inversion in the last 50 years, again, it's led to a recession. It doesn't cause the recession, but it's an indicator that one's likely to happen. So if history is any precedent, it would not be a huge surprise to see a recession sometime in the next year. In the housing market itself, we're not seeing a whole lot of strength right now. May marked the 10th consecutive month where we saw existing home sales decline. It was the 5th consecutive month of lower monthly numbers. I suspect we will see June numbers, which usually go up, also go down as well. And the reason for this, we'll talk a little bit about inventory in a minute. Low inventory is certainly a factor, but I believe what we're seeing right now is an affordability issue that's caused by interest rates, mortgage rates that have virtually doubled in the last year. That's taken a lot of people out of the housing market, and that's one of the implications the housing market has for the commercial market, is that we're going to continue to see household formation. Those people need to live somewhere. We've done extensive research that indicates most people still prefer to live indoors. If they can't find a house to buy, they're going to look for a place to rent. And so that's going to have definite implications for the rental market. The new home market has been a little bit more up and down, but more down than up. And the numbers, if you look at the year to date, are actually falling faster than what we're seeing in the existing home market. But again, year over year numbers not looking great in the new home market. And since new home sales tend to be more expensive, they run into some of those affordability issues as well as interest rates have spiked up. Inventory is improving. We may be getting back to 2019 levels sometime soon, but 2019 levels weren't all that high to begin with. In a normal market, there's about a 6-month supply of homes available for sale. Right now, there's a little over 2 months supply, which is up, but still about a third of what we would see in a market that is in a state of equilibrium. For those of you wondering if we're facing another housing crisis like we did in 2008, one of the factors we're not seeing this time that we saw last time was an oversupply of houses. In fact, going into the Great Recession, there was a 13-month supply of homes available for sale. So the builders never got the memo and they just kept building beyond what the market would bear. So again, juxtapose 13 months, twice as much inventory as we normally would be able to absorb, with 2 months supply, which is a third of that absorption rate. So that's one of the big differences in today's market. Builders simply haven't been able to keep pace, although we're seeing a shortage of existing homes available for sale as well. This is a chart from a site called Calculated Risk. And what I like about the chart is it breaks new home inventory into 3 stages. The red stage is properties that are completed and available for sale. The blue stage is properties under construction available for sale. And the green area is properties that haven't been started yet. Basically, the permit's been issued, maybe ground's been broken. And what we're seeing is a real dichotomy right now. The red area, the properties that have been completed and are available for sale, is the lowest it's ever been. It's about a half a month supply. The green area, properties under construction, is the largest number we've ever seen. So we're seeing more homes under construction available for sale than what we would normally see. So people are so anxious to find something to buy that they're buying these properties. So one of the things to watch for in this market segment over the next year is, are we going to see an increased number of consumer cancellations because of affordability issues, as those interest rates have gone from 2.5% and 3% to almost 6% on a 30-year fixed rate mortgage, increasing your monthly payments by anywhere from 35 to 50%. So we're seeing a little bit more cancellation activity, but it has not yet reached crisis levels. But again, something to watch as we move forward. Today, there was an announcement that single-family housing starts fell by 16% compared to last month. So the builders clearly are paying attention to what's going on in terms of sales volume. Builder sentiment is very, very low right now. They're concerned about affordability. And so the likelihood of the builders overbuilding this cycle, probably pretty low. We talk about interest rates rising. This chart shows just how dramatic the rise has been. And the combination of home prices continue to appreciate because we do have strong demand coupled with low supply. And these interest rates has simply made homes unaffordable. This is from an affordability report we just put out at ATTOM about a month ago. And all those dark red areas are areas where the affordability is lower than historic averages. So we take a look at affordability as somebody paying about 28% of their take-home pay. 28% of their income on housing. And as you can see in huge swaths of the country, the properties are less affordable today than they were a year ago, and certainly less affordable than they've been historically. And that's due to that combination of home price appreciation, which continues to be going up in double digits, and interest rates going up. I will say that it appears that assuming mortgage rates hold in the 5.5% to 6% range, it's very likely we're going to see home prices start to appreciate at a much lower rate. The forecasts for June are lower than they were for May. May was still 15–16%, depending on whose numbers you were looking at. Estimates for June are that home prices will probably go up by about 12%. But by the end of the year, if mortgage rates hold, we should be looking at home price appreciation rates in the low single digits, 3, 4, 5% year over year home price appreciation, which is a much more normal trend than what we've seen before. So if interest rates hold, home price appreciation slows down and wages continue to go up, we get inflation under control by the end of the year, affordability should feel a lot better for a lot of potential buyers. We are seeing price reductions getting closer to normal levels. In a normal market, about a third of list prices are reduced prior to sale. That's been much lower over the last few years, but that dark red bar you see there is a pretty significant spike. These numbers courtesy of Altos Research, another partner of ours. And you can see that we're starting to see more list prices reduced more quickly than what we would normally see this time of year. Anticipation is that we'll continue to see that happen as people have really too high expectations for the property values as they're putting their properties on the market. The slides I'm showing you right now, excuse me, to me are all indicators that we're seeing a weakening of demand. This is a pretty obvious one. This is a purchase loan application index, excuse me, put out by the Mortgage Bankers Association, and the yellow line there is this year. And you can see that now that line is running below both 2019 and 2021. I'm kind of discounting 2020 because it was such an anomaly due to the pandemic and the government shutdown, but we're running at about 20% fewer people applying for purchase loans than in either 2019 or 2021. Pending home sales, you probably read this report from the National Association of Realtors. The press covers it every month. They've been talking about a 5 or 6 month downward trend because they're looking at month over month. I look at this on an annual basis, year over year, and it's been over a year now with pending home sales being down lower than they were prior year. And if you look at California home sales as being kind of a bellwether for the country, and a lot of people do tend to look at housing trends starting in California, you can see that in June, home sales were off by almost 21% in California, and for the year, they're almost off 11%. The other things we're seeing are an increase in inventory and an increase in days on market, although it's still very low historically speaking, but we're not seeing a lot of those instant sales that we were seeing a few months ago. Prices are still going up, but going up at a slower rate. You see that the prices went up in June by a little over 5%. And if I'd shown you this chart last month, it probably would have been at about 9%. And the month before that, it would have been double digits. It's not inconceivable that we will see price decreases in certain markets. Probably some of the higher price markets, particularly at the higher price points. So we could see coastal California, the Pacific Northwest, markets like Austin, some Florida markets experience price declines, particularly at the high end. But we're not talking about the 30, 40, and 50% price declines we saw during the housing crisis. We're talking about maybe something more like a 4 or 5% price decline. We also might see some of the markets that just went crazy last year: Boise, Idaho, St. George's, Utah, Phoenix, Arizona, where prices were up over 30%. We could see a reversal and see prices come down a little bit in those markets as well. So what other trends are we seeing, or what trends are driving these trends? One of the reasons we believe housing demand will continue to be high is because of demographics. These numbers courtesy of Freddie Mac. We have the largest group of 25 to 34-year-olds in history forming households right now. Prime age for buying a property for the first-time home buyer is 33. So you can see the way this huge wave of households being formed. I believe when we adjust data that was collected during the pandemic, we're going to find that the household formation numbers were actually understated because it was hard to count when you couldn't leave or couldn't get to somebody's house. And you can see the vacancy rate on the right-hand side has been declining both in terms of homes and in terms of apartments for rent. And that's because we're seeing this increase in household formation. So again, with affordability becoming an issue, households being formed, we're going to see more of these people that would have bought decide to rent temporarily until prices are a little bit more predictable or under control. Another trend we're seeing is an out-migration from some of the more expensive markets, markets like San Francisco, the Bay Area, Silicon Valley, New York, North Jersey, Los Angeles, even Honolulu, but the Chicagoland area. A lot of out-migration from those areas into lower tax, lower cost states. And that's what drove a lot of that increase in places like Boise and St. George's last year. Implication for business here. Leading up to the Great Recession, I'll give you a California example. We had people moving out of LA, out of Orange County, out of San Diego, into an area in the Central Valley called the Inland Empire. And they moved there because it was where they could afford to buy a house. But these were purely bedroom communities. So people would go home at night, they'd sleep there, they'd get up in the morning, have an awful commute to LA or Orange County or San Diego, and then commute back. In this economy, they're actually moving not just because they can afford houses in these markets, but because there are now jobs there. So in some of those markets, you've seen a huge explosion in industrial facilities, whether it's warehouse and distribution for e-commerce providers, whether it's cannabis facilities, but a lot of jobs have been created. So people aren't just going to a bedroom community, they're going to a community. And as they stay there, you're seeing other businesses form. So you're seeing retail activity, office activity, hotel activity in a lot of these secondary markets. And that's a trend we expect we'll continue to see. The other trend that factors into this, of course, is people now can work from home. And if they can work from anywhere, they're going to where they have a higher quality of life, more affordability. And we're seeing that trend continue as well. So those will both continue to affect housing, which will, of course, affect the commercial markets. We are seeing an increase in investor activity. Investors purchased probably between 20 and 25% of all residential units in the first quarter. I did want to disavow one meme you've probably been seeing, which is that Wall Street is actually not buying Main Street. Investor activity has gone up slightly, and that includes iBuyers, companies that buy these properties and then sell them almost immediately, trying to make a profit in an arbitrage model. And so those investors really aren't taking inventory off the market, they're putting it back on. But the investor activity is predominantly small to mid-sized investors. Mom and pop investors still own over 90% of the single family rental units, for example, that are out there in the marketplace today. So institutional investor activity has increased, but it's only increased from about 1% to about 2.5% over the last couple of years. So it's an increase, but it's not huge institutional investors coming in and gobbling up all the residential properties. A lot of those institutional investors have actually moved into a build to rent model, which means they're working with the builders to create rental units rather than competing with small investors and consumers for properties to buy. Another implication, by the way, for the commercial market when it comes to construction of rental units. Fix and flip activity, according to our numbers, is the highest it's been in 15 years. In the first quarter of this year, 10% of all residential sales were flips. That's higher than usual, and the raw number of flips was also the highest we've seen since we started charting these numbers back in 2000. So a lot of fix and flip activity, and that's very typical in a market with high demand, low supply, and quickly rising prices. So it'll be interesting to see what happens as the market shifts. We're already seeing profits and profit margins for flippers compressed because prices aren't rising as quickly as they did, and they paid top dollar to get a property. And in addition to that, these are gross profits, but if you look at net profits, the cost of labor has gone up, the cost of materials is going up, supply chain disruption has caused that. And so flippers are really going to have to be very, very cautious about what they do buy and how they price what they buy and what they sell in order to avoid the trouble we saw during the housing crisis 10 years ago. On the single family rental market, we've seen gross yields decline in year one after the purchase. And that's just the annualized rental income divided by the median purchase price. So rents simply haven't risen quite as quickly as purchase prices have. And that has an impact on that first year annual yield. The good news is over time, that will improve because you've only paid for the property once. But as I mentioned, home price appreciation has outpaced rental rate increases. Yields dropped, according to our numbers, in 75% of counties where home prices were above $250,000, and 67% of the counties where sales prices were below $250,000. And then yields are running counter to home prices. But what we are seeing is that both rental yields and home prices have continued to outpace wage growth, which is why affordability becomes something of an issue. I apologize, I'm going through this pretty quickly. We can hopefully cover some of the things I've glossed over in the Q&A, but again, trying to cover a lot of stuff here. Foreclosure activity has begun to come back. You can see when the government foreclosure moratorium was put in place, when the foreclosure payment holiday was put into place, the forbearance program, we saw foreclosure activity go down to historically low levels. So we're seeing double-digit, sometimes triple-digit year-over-year increases in foreclosure starts, but we're still back to about half of normal levels. I don't expect that we'll see foreclosure activity nationally back to normal levels until sometime in 2023. The one factor that could skew that thought process is if we do hit a recession and the recession removes a lot of jobs from the economy. Historically, you can usually draw a pretty straight line from unemployment rates to delinquency rates to foreclosure rates. That hasn't been the case the last couple of times we've gone through this process. But if we do have a serious recession next year, that could cause foreclosure rates to spike a little bit more than what we're anticipating, particularly in the FHA borrower pool, where there's typically lower equity, typically lower cash reserves, and the borrowers, frankly, just have less wiggle room to avoid a foreclosure. One of the reasons we're not expecting a ton of foreclosures is there's a record level of homeowner equity, about $27 trillion of homeowner equity, and even 90% of the borrowers currently in foreclosure have positive equity in their homes. One trend we have seen is that commercial foreclosure activity has increased a little bit more than we would have expected to coming out of the pandemic. So whereas normally we might be looking at 200 to 300 foreclosure actions in the commercial market, right now we're looking at about 400, and those numbers have been going up pretty steadily. So as Ben can tell you, there's not usually a lot of foreclosure activity in the commercial market. A lot of the mortgages there go against multiple pieces of collateral, multiple properties. So usually there's some sort of workout that takes place as opposed to a foreclosure. But we're seeing this across the board. We're also seeing a higher level of activity on large scale foreclosures, places like the Roosevelt Hotel in New York, the Marriott, Midtown Manhattan East, big properties. And I don't think it's a coincidence starting in the hotel industry, since I think that industry has probably been hit among the hardest short term by the pandemic. So we'll wrap this. The economy continues to be resilient, but there's a very real possibility, in my mind, a probability we're going to see a recession in the next, I'd say 12 to 15 months at this point. Rising mortgage rates and home prices and inflation are making affordability an issue for a lot of prospective home buyers. We're likely to see sales volume slow down. Price appreciation will probably slow down with that. Fix and flip investors, and for that matter, single family rental investors need to sharpen their pencils when it comes to purchase and repair costs to avoid getting themselves into financial difficulty. But the lack of affordable inventory is likely to result in more demand for rentals. I don't believe there's enough inventory coming to market in the rental market to overwhelm the amount of demand we're going to see as household formation increases. And for those of you interested in foreclosures, we're going to continue to see activity increase steadily but slowly, and we probably won't be back to normal levels until sometime in the next year. So with that, Ben, I will wrap up. People are welcome to visit our website, take a look at the market trends area there. We're publishing a lot of free reports, and feel free to reach out to me on Twitter and LinkedIn because I'm talking about this stuff all the time.
Thank you very much, Rick. And thank you for giving us 2 hours worth of content in 30 minutes. Rick, I have a question here from Alice. So what would have to happen in order for rents to drop either in dollar cents or as a percent of income, given that we seem to have increased consumer spending, higher mortgage rates? You said something about home formation being an all-time high, and inflation, right? So what would have to happen for rents to drop?
Right now, it's all supply and demand based, and I think that's the biggest contributing factor. There's simply, I believe, the last number I saw from RealPage was there was something like 4% vacancy rates in the multifamily market across the country, and that's just driving demand. So asking rent prices are up about 13% year over year. If I'm going to speculate, I would speculate that we hit the same sort of affordability wall in the rental market that we're starting to see in the sales market, and that renters just decide to stay put, stay where they are, move back with family, share an apartment, and the demand weakens. A recession could also lead to higher unemployment, which could lead to lower demand. So those would be my two most likely scenarios. If you want a little bit more nuanced theory, I don't see rents falling at the low to mid end of the market, your B and C classes. Most of the new construction is at the luxury end or the very high end. And those apartments could be the first victims of unexpected vacancies. If that happens, there could be a trickle down effect into the A category, but right now, I just see the supply being overwhelmed by demand. And as long as that's the case, hard to see prices coming down nationally. Local market conditions will vary.
Thank you. I wouldn't be true to the name of this webinar series if I didn't ask you, what's changing technologically, if anything, that's helping you in your predictions? Are you seeing any new tools, any new data sets, or anything at all that's helping you do a better job?
This is a cop-out of an answer, but the truth is, for what I do, I'm an observer and a student of what's going on economically, and there's more and more of that data being published online. So just the availability of online tools to be able to go find the data that I need, but in terms of numbers crunching and things like that, you'd be surprised how much this data is still done in Excel or with calculators. So in some ways, what we're talking about today is still kind of in the dark ages when it comes to technology. And you know this, you wouldn't have founded Cherry. The real estate market is just rife with people that are using old technology or no technology at all. So it's why companies like yours have come around and filled a void for those needs.
Thank you. So if you could have a magic lens into the data sets that already exist in various companies' private data sets, right? What do you think that is out there that might be impactful? So I'm asking about the data sets that you don't have access to, but presumably exist somewhere.
there's data sets that are available in aggregate that are not available at the individual level because of privacy restrictions. It would help me predict what's going on if I could see who's in default on a loan, or who's delinquent on a loan early. If we could see student loan delinquency rates, if we could see credit card delinquency rates, auto loan delinquency rates. But right now, it's kind of normalized and aggregated. And those tend to be early predictors of other market conditions. Be great to have a little bit more insight into real-time hiring trends, because all of that is lagging data. Population migration trends, the Census Bureau data, typically is hopelessly out of date. So that makes some of the forecasting, some of the predicting that we all do, a little problematic, a little fuzzy, because we a lot of what we talk about has to do with people moving in and out of different areas. And what's helping us right now with that is seeing home sales. So we're seeing home sales actually before we see the census data, which is just the tail wagging the dog. But those are the kind of things, if we get down to a more granular level, a more real-time analysis and assessment of the data, those would be things that would make a lot of our forecasts more accurate and more reliable.
Anything new around office space? Is the industry reaching a conclusion around, are we going back to the office, not going back to the office? Are we seeing that reflected in prices at all?
Actually, yeah, I believe we're seeing it reflected in prices and not in a necessarily positive way. Last quarter was the first quarter since the pandemic was declared that the office market showed a positive sales price, and it was an increase of, I believe, about 1%. All of the other major sectors, retail, hotels, industrial, multifamily, all of them had very strong quarter over quarter and year over year price increases, not so much in the office. And I believe that's because vacancy rates are still high. So the return to office has been more difficult for the companies that wanted to go back. There's a lot of stuff going on. So, Midtown Manhattan certainly is ground zero. We've seen similar issues in Los Angeles and San Francisco. But even in Silicon Valley, you see this on again, off again nightmare with Facebook and Google telling their employees to come back next week. Nope, just kidding. And so I think the jury's still out. I do think we'll ultimately see, and this is just my opinion, we'll ultimately see more of a hybrid workforce. I think it's hard to maintain company culture and to train new employees in a remote environment than it is in an office environment. But I think COVID has proven that you can have a highly productive workforce, particularly in certain industries that is almost entirely remote. The one other area I point out, Ben, is that the suburban office markets have recovered and their prices have risen significantly better than central business districts have. So you're kind of seeing secondary markets and suburban markets recovering better than those central business district office markets have. And there's a lot of discussion right now among people I talk to about some of those central business offices being repurposed into multi-use facilities. So now it's not just office, it's retail, office, maybe even residencies in those buildings.
Do you think we'll see foreclosures in this commercial market?
I think we'll see more than usual, but I don't think we'll see a flood. And one of the, I might have given you a different answer a few months ago, but one of the things I've noticed recently is that CMBS delinquency rates have steadily been coming down to where they're actually back down to normal or slightly better than normal. If we were seeing payments slowing rather than improving, that'd be a cause for concern. But one of the reasons jury's still out is because a lot of tenants are in long-term leases. So in many cases, you won't see the impact on that particular building or for that particular owner until that lease doesn't get renewed, or the renewal comes with very tenant-friendly terms. So yeah, we're not out of the woods yet. I don't think the full impact of COVID on the office market is something we'll know for another 2 to 3 years.
Thank you. Another question from our team here. Can you say anything about institutional fix and flip versus individuals doing a fix and flip? Do you have any data on that, or what's going on there?
Yeah, that was one of the things I flew by toward the end of the deck, and I apologize for that. So Freddie, you want to check out Freddie Mac's website. They just published something on the single family rental market. And that's not fix and flip, but it runs parallel. The institutions don't engage, the big institutions, the Blackstones, the BlackRocks, don't engage heavily in fix and flip. They're much more inclined to buy and hold. So they'll buy something, they'll fix it, and then they'll rent it out. And a lot of them have formed REITs or gone public with their holdings. And collectively, they still own about 3% of all of that inventory. What we are seeing that you could call institutional fix and flip are the offer pads and open doors. Up until a few months ago, the Zillow offers, and who proved how you really do have to be careful about how much you pay for homes that you're going to flip, or you can lose $300 million in a quarter. I think the survivors nationally have sharpened their pencils and figured out the model. They're also now doing a lot of ancillary services, which is probably where they're making a lot of their profits. Title, loans, the whole 9 yards. What I think we're going to see in that market, and by the way, collectively, there's still a fraction of a percent nationally. In certain markets, and Atlanta and Phoenix come to mind, they are much more significant, and we do see them have an impact on those local markets. But if I had to take out my crystal ball, I think what's going to happen there is what happened in the single family rental market. Everybody thought the huge institutions were going to gobble all the inventory up and own that market. They're still all the way up to 3% as a group. But what we did see was mid-size investors, and they became, I called them super regionals. They'd own a few hundred, maybe a few thousand properties in a given region, a state, a couple small states. I think we're starting to see the same thing happen in the fix and flip market, where you're getting instant offers in a market like San Diego or Nashville or Phoenix. And it's a regional player, it's not a Blackstone. And so I see that as that mid-tier professional investor, not mom and pop, but also not Blackstone. And they have enough expertise in their local market that they can probably avoid the kind of trouble a national player might get themselves into.
Rick, I always learn so much listening to you. Thank you very much for joining us on today's presentation. Everyone, please give him a follow and connect with him on LinkedIn. And Rick, I heard you say that you have to say that you watched this webinar because too many people are trying to connect with you on LinkedIn. So please do that.
Yeah, mention where you heard me from, because I get a lot of really interesting requests to connect on LinkedIn from people. You do. I've
been getting the same recently. Yeah. So thank you very much. I appreciate you and your team. Again, it's a pleasure to be working with you as a Cherry partner. And I thank the Cherry folks for helping make this happen. So thank you very much. We'll end there. Thanks, Rick. Bye-bye.
Thank you.
Thanks, everyone, for joining. I'm going to end the webinar and the recording.
Bye-bye.